Oftentimes people see advertised rates online or maybe they hear it on the radio, but those advertised rates almost always come with fine print, points, or origination fees being paid. And they also make assumptions about the details of the file. There's actually over 30 different loan level pricing adjustments that can impact the interest rates you're offered. If we weren't competitive on rate, our company wouldn't be able to help almost 30,000 clients a month. It's actually almost everyone's first question. And everything's really determined by the secondary market saleability and risk. So loans are originated on the primary market through lenders like myself to consumers like you, and then sold on the secondary market or transferred to a servicing department, which may feel like it's being sold. There's banks like B of A, Wells Fargo, and credit unions that raise money through their depository and then lend that money back out through interest-earning products like mortgages, auto loans, credit cards, that sort of thing. And since it's their own money, they can sometimes lend at lower rates, but they also typically have very stringent guidelines to only lend at that low rate when there's almost no risk and plenty of certainty that the loans could be sold in the secondary market. Then there are direct lenders like loanDepot who go to a large investor like UBS and obtain warehouse lines, which are basically just sums of money that can then be used to fund loans like yours. Just like a credit card, there's a limit to the funds that a direct lender has access to, and there's interest that loanDepot pays on the money that they borrow to fund your loan. So to free up that money so that we can continue to lend to people needing mortgages, the funded loans are then sold on the secondary market. And then on the secondary market, buyers of these mortgages are typically, government agencies like Fannie Mae, Freddie Mac, PennyMac, or another institution like Chase, Wells Fargo, or even Wall Street. If there's nobody willing to buy a loan on the secondary market, then the lender has to keep the loan, which will keep them from making future loans and lending to another home buyer. If that's the case, we'd likely need to service the loan ourselves until we can show timely payments for 12 to 18 months. And at that point, the market will probably see the loan as less risky and purchase it. Now, because of this, Freddie Mac, Fannie Mae, VA, and FHA loans have the requirements they do because it increases the likelihood of timely payments, and those type of loans have those guaranteed buyers. So lenders like to use those products. Now, interest rates are sometimes based on the compensation of the loan officer, but that's not how it works here. If I could lend to you at 0%, I would, because there's zero relation between your rate and my compensation. If your loan is in fact sold, and it most likely will be, institutions then package loans up together and create an instrument called mortgage-backed securities. And those mortgage-backed securities can be invested in. The sale of those mortgages is known as securitization, and that basically frees up capital to lend to future borrowers like we spoke about earlier. Now, the ability to sell the mortgage-backed securities is simply a matter of supply and demand. If demand's high, that leads to the increase in the cost of mortgage-backed securities, and yield on interest rates fall. Now, on the other hand, if there's low demand, that leads to the cost of mortgage-backed securities falling and the interest rates and yields go up. If a loan has a high likelihood of being refinanced or otherwise paid off in the short term, that's bad for investors, so it impacts their strategy. And a lot of these investors are pensions, life insurance companies, other countries, hedge funds, for example. And for this reason, the secondary market's willing to pay less. But because of this, the original lender on the primary market has to increase the cost of rates in order to turn a profit. Now, pretty much every company borrows money from the same places and re-lends the money out in the form of mortgages, and then sells those mortgages to the same places. So there's really not much room for companies to offer much lower rates, of course, unless that company is willing to take a loss. Rates can vary from bank to bank, but it's typically 1/8 to 1/4%. Really not much different than paying 10 to 50 cents more per gallon when you choose which gas station to go to. The real difference is who you work with when you're buying a house matters. And I'm not trying to brag, but it is important that you know what our reputation means in terms of giving you a pre-approval that's strong, underwritten, to help you get your offer accepted. And we're going to protect your earnest money deposit, getting your loan closed on time and providing exceptional customer service that really goes above and beyond to make sure all your questions are answered and you have all the information you need to make an educated decision before, during, and after you make the biggest purchase of most people's lives. If you've got any questions, feel free to reach out.